As we go into December, December is a notorious trend-killing month. It's a notorious year-killing month. It's a month that has seen hedge fund managers lose their entire year in the month of December. So it's always important to understand how December behaves. December is a wild card every year in terms of how the markets behave, particularly as we start moving towards Christmas. So from December 15th, 20th through Christmas week up till New Year's, the market can behave very erratically. So one of the things you always want to remember is that when there are big trends on, you tend to have everybody on that move. And so any kind of counter trend moves, two things happen. You have players in the market who have profits and they don't want to see those profits disappear. This means the loss of management fees and the loss of bonuses. So they get hyper aggressive to protect their profits in the month of December. And so because there's this hypersensitivity to the protection of profits, you often get these violent one-way moves that happen in December as everybody is liquidating to try and protect their profits. This often happens, and then the trend resumes in January anew. So as we go into December this month, we have a lot of markets that are in transitions. And so we don't have, one of the things Mark and I spent a great deal of time doing is trying to identify the top trends. But as we come into the end of this year, the markets that have been in top trends in the last 3-4 months, they are all in a state of transition. So when we look at this list is actually very small. There's a couple common things you can see. You can see one, you can see weakness in the Canadian dollar. This is showing up in these crosses, Euro CAD, Sterling CAD, the New Zealand dollar, Kiwi CAD, and then on the downside, you can see the CAD versus Swiss. So the Canadian dollar is weak, but notice what's not in here. It's not in here versus the dollar. It's in here against other crosses.
Chuck, we lost your camera.
There you go.
Awesome, thank you.
So you can see that the New Zealand dollar is in here, both as a long and as a long here against the Aussie dollar, but there's not a lot here. Then when we look at outside of FX, you'll see we have natural gas. Natural gas is really interesting to me because natural gas is enormously high volatility. And there's a lot of fear going into winter surrounding natural gas. So one of the things I always remember is if there's fear in the market and people are really scared of the upside and it's going down, it's probably going a lot lower. And then we have wheat and we have coffee. Wheat was making new lows today, and coffee has been down near its lows. Okay, so in the WAM-RS report, this is one of the things that's going to jump out, is look at the shifts in the last month. You can see dollar index is a leader on the downside. It was one of the strongest trends of the year. It really fell apart. Crude is weak. And on the upside, yen, which has been our favorite short all year long, you'll see the yen is leading in relative strength, increasing on the upside, along with the euro and the 30-year bond. You can see in the WAM relative strength 20, you can see all of these that have been going down this year that are in this transition phase and rally. In the sector ETFs, you see some big shifts in the sector ETFs. XLE, which has been a leader all year, it's still not bad. It's still up there, but it's been weakening. But you can see XLK, which has been beat up all year, coming off the bottom, really strong. Emerging markets coming off the bottom, and then communications and staples coming off the bottom. And again, you can see these big relative strength shifts going on as the market is transitioning off the lows. Okay, so with that, I'm going to turn it over to Mark as we get more into the macro picture.
First thing we want to look at today is is the yield curve. So we've got here, this is the 3-month 10-year yield curve, and this is the 2-year 10-year yield curve. And a couple of things about this. Generally, when we have both the 3-month and the 2-year in inversion, like we have now, every single time that's happened since World War II, we've had a recession somewhere in the next 12 to 24 months. Okay, so we've been inverted, and the other thing to look at that I want you to look at is the degree of inversion. Right, we think of an inverted yield curve as like the gas pedal or brake of lending, right? Because banks basically borrow short-term and lend long-term. So when the short-term rate is above the long-term rate, doesn't make sense for banks to lend. They're going to lose money. They're going to borrow short, lend longer. The short rates are high, so they're borrowing at a higher rate than they're lending. Doesn't make sense. So lending stops. And that's why it's sort of a cause and effect relationship, why an inverted yield curve leads to the much lower degree of lending that slows down the economy. So the degree of inversion on the 2-year is more than we've seen since 2000, and on the 3-month 10 is getting as high as 2000s. Generally, the higher the degree of inversion and the longer it lasts, the deeper the recession. The other thing I want to point out about inverted yield curve, it's really important to want you to understand, these green lines are the bottoms in the market, just coming after the bottoms in the market. What I want you to see is you don't get a bottom in the stock market and since World War II, when you've had an inverted yield curve, until the yield curve steepens to at least 100 and often much more than that. Well, what that tells us right now is we're not in an area where we would actually be looking for a sustained bottom in the market because the yield curves are still heavily inverted. That means lending activity is being cut back substantially, and that's going to weigh on growth ahead. And we haven't had the steepness that then brings lending back in and starts to turn the economy around. So realize that we have never not had a recession since World War II with this kind of developments, both of these yield curve being inverted. Realize that deeper inversions tend to correlate with bigger recessions, and realize that the market is unlikely to bottom until the yield curve starts steepening at least to about plus 100. We're not close to being there. The other thing that's happening this time that doesn't happen very often is the global yield curve is inverting. The global yield curve has been a good predictor of recession for the global economy, or for at least 2/3 of the main economies in the system since World War II. If this tells us that we're likely to have a recession, it's likely to be a global recession. And then the other point a lot of people bring up is until the yield curve starts to come back, you get most of the decline in the stock market, generally in bear markets. So look at when you started inversions and how much more you had to come. We haven't really gone that much since we started our inversion here. It's likely that we're going to go more, especially with the inversion being so deep. So from a sort of a liquidity perspective, it's not likely that we're seeing a sustainable bottom here yet. The other thing I want to point out is the Taylor rule, which is something that policymakers use. And in fact, John Taylor wrote a book that basically recommended using this as a primary tool of the Federal Reserve for where interest rates should be. Look at where the Taylor rule says interest rates need to go. Above 6% if we're going into recession, and if we're not, above 7.5%. So it's possible that the Fed has more tightening than the market is realizing yet. The Taylor rule implies that we need to go further than analysts and then Federal Reserve officials are currently talking about. The other thing that's important to note is what's happened to the savings rate. Savings rate exploded higher when we got all those stimulus checks, but that's mostly been spent, and now the savings rate is at new lows since World War II, really. Okay, now think about this. The US economy for the past 20 years has really needed cheap capital. Savings is one of the sources of capital, and without a large pool of savings that it's had. So now that savings is depleted, if interest rates go higher, it's going to be very difficult not to have a further recession. We have a ton of macroeconomic tools that we look at, that we compile, that have had a very good track record at predicting recession. And here are a couple of them. One is leading economic indicators, going way below zero, and we've done that recently. And the other is the leading economic index falling below its 18-month moving average, and that's happened too. Both of these are now clearly predicting recession. And so we're going to be looking at a bunch of different macro tools. They're all in concert predicting recession for the most part. Here's another one. Chicago PMI falling below 40. See, every time that's happened, there's been a recession since World War II. It's called 8 of the last 8 recessions, and it's not had any misses. So this is yet another tool. A lot of PMIs will look at ISM PMI below this. They're all telling us that we're likely heading into recession pretty quickly here. This is the ISM PMI falling below 50, which forecasts recession. And then I want you to realize that, okay, so we've got leading economic indicators, we've got PMIs, we've got the yield curve, we've got a lot of things telling us that we're very likely to be in a recession, and potentially a deep one. And what's happened to stocks is they've fallen on par with bear markets that have not been accompanied by recession. So it's likely, if we do go into recession, we have more downside based on just the average that markets fall when you get a recession and a bear market. Other thing I want you to notice is that we have models. These are models from Morgan Stanley that basically do a pretty good job of anticipating moves in both earnings and in leading economic indicators. And both of these are collapsing. They're falling very sharply. Suggests that we're going to have earnings declines that could be very sharp, and we're going to continue having a degradation in economic indicators ahead into recession. The normal earnings decline during a recession is a 26.5% decline in earnings. We've had something like 5% so far. So we likely have a substantial amount of earnings declines coming up, either starting in Q1, most likely, or in Q2. We're going to start to get earnings declines. And what generally happens when we start to get earnings declines is that analysts begin to say, oh boy, we haven't really anticipated this. Analysts are looking at double-digit earnings increases next year. So what happens usually as you go into recession, the recession starts to bite, is that analysts trip all over themselves to revise their estimates lower, and that is one of the things that leads the markets to fall sharply. And then the other thing to realize is just looking at the average bear market with recession, we haven't fallen really to the normal average levels in anything, in ISM, PMIs, in unemployment, and in earnings decreases. Okay, and Goldman Sachs has a good chart here, and they're talking about bear markets since World War II, and they have cyclical, which are a lot of the non-recessionary bear markets, and structural, things like when we have a bubble of high degree of overvaluation, or we have structural problems in the economy, where we have talked about how we have a lot of structural problems in terms of supply chain problems, in terms of inflation, in terms of a lot of things. Normally, when you have a structural recession, you have the deeper bear markets, over 50% and averaging over 40%. And they last longer. Instead of lasting an average of 15 months, they last an average of 2 years. Another thing that normally happens in a bear market, particularly one accompanied by recession, and this didn't happen in 2020 because as soon as before we started the recession, we got massive stimulus. So it's a very, very short recession. But generally during recessionary bear markets, you get valuations that correct to more normal levels. All we've corrected to, by the way, this is the biggest valuation splurge, the highest valuations for stocks ever, including 1929. And we have only just declined back to the highs of 2000. So likely, if we do have recession and we're going to get a bigger decline in valuations that accompanies a normal bear market accompanied by recession.